You've been told the inflation crisis is over, that the worst is behind us. But the latest numbers from the government tell a different, more alarming story. The CPI report for June 2025 just dropped, and it's a red alert for the US economy. What we're about to show you goes beyond the headlines. It's a hidden conflict inside the economy that could change everything for your money, the stock market, and the Federal Reserve's next move. So, what is really going on? Okay, let's get straight to the facts. On July 15, 2025, the Bureau of Labor Statistics released the Consumer Price Index, or CPI, for June. The headline number, which measures the average change in prices we all pay, jumped to 2.7% over the last year. That's a big acceleration from the 2.4% we saw in May. But here's where the real story begins. If you look under the hood, the economy is telling two completely different stories at the same time. For over a year, the big problem was services inflation, things like rent and insurance. But that's actually starting to cool down. The new problem? Goods. Prices for things you buy in a store, furniture, clothes, electronics, are suddenly catching fire. So what's causing this? One word: tariffs. Economists have warned for months that new tariffs on imported goods would eventually be passed on to consumers. And this CPI report is the first hard proof. We saw huge monthly price jumps in tariff-sensitive categories: household furnishings up 1%, recreational goods up 0.8%, and apparel up 0.4%. This isn't random. It's a direct consequence of trade policy hitting your wallet. This puts the Federal Reserve in a nightmare scenario. Their job is to keep prices stable and keep people employed. But the new inflation data forces them to choose. If they keep interest rates high to fight this new wave of inflation, they could crush the economy and the job market. But if they cut rates to help the economy, they risk letting inflation get even worse. They are trapped. While the Fed is stuck, the bond market has already made its decision. The 10-year Treasury Yield, which is the market's best guess on future growth and inflation, is telling us something crucial. It's been stubbornly high, even when the Fed was hinting at cuts. The bond market was essentially calling the Fed's bluff, and this CPI report just proved the market was right. It's the ultimate lie detector, and it's signaling that this inflation problem is far from over. So what does this all mean? We are theoretically entering a new, more complicated phase of this economic cycle. One where government policy is directly fueling inflation, putting the Fed in a bind, and making the future of the economy more uncertain than ever. Understanding these forces is the first step to protecting yourself. Music swells. If you want to stay ahead of these massive economic shifts, make sure you subscribe to the channel and hit that notification bell. We break down complex finance so you don't have to. And let us know in the comments, what part of this CPI report worries you the most?